Hey everyone, welcome back to the channel. Today we're diving into some interesting news that you absolutely don't want to miss. Whether the reason is a layoff, a medical emergency, or a pile of debt that is more than you can afford, struggling to pay credit card bills is a problem many people face. When you stop making credit card payments, you could not only be charged late fees and higher penalty interest rates, but also take a hit on your credit. If your unpaid balance lingers for too long, your account may go to collections, and you could be served with a debt collection lawsuit. The more recent the collection, the more it will hurt your score, according to FICO. That said, the damage can last a long time, says Todd Christensen, education manager at the MoneyFit Academy, operated by Debt Reduction Services, a nonprofit debt management and credit counseling service in Boise, Idaho, and author of Everyday Money for Everyday People. Keep in mind that just because you might get caught up on your payment, whether it was 30 days or 90 days late, the note remains on your credit report for 7 years as a negative mark, Christensen says. Here is what you can expect when you've stopped paying a credit card. The stages of credit card delinquency. A credit card payment is generally considered late if it's received after the due date. But it won't end up on your credit report until it's 30 days past due, according to the credit bureau Equifax. Some creditors don't report late payments until they are 60 days overdue. Even if a missed payment is not immediately reported to the credit bureaus, you could be hit with a late fee, Equifax notes. As missed payments pile up, the consequences can become more severe, says Jeff Arevalo, financial wellness expert at GreenPath Financial Wellness. If the debts continue to go unpaid, then a person may face charge-offs and even more fees and penalties, he says. The cumulative consequence will make it harder for someone to pay the debt off and can potentially push any of his or her financial goals even further into the future. What happens if your payment is 30 days late? Your credit score could drop once a late payment shows up on your credit report. The reason is that payment history is the top factor affecting your FICO score, making up 35% of it. Missing a payment by 30 days could cause a credit score to drop between 50 and 100 points, Arevalo says. I've heard from consumers who saw their credit score drop by 70 points because of a single missed payment, Christensen adds. Several details determine the effect of a late payment on your score. For example, the more recent the payment is, the more it could damage your score. The further in the past it gets, the less it hurts, Christensen says. Your credit rating can also influence how much missing a payment might sting. The better your score when you miss a payment, the more your score will drop. What happens at 60 days late? As you might expect, the financial pain is worse for a credit card payment that is 60 days late than for one that is 30 days overdue. The later the missed payment becomes, the more it can hurt, Christensen says. At this point, you might be subject to more fees and penalties and see your credit score drop even more. If one's credit history is shorter or already in a negative status, the individual may not see quite as large a drop, Arevalo says. But the damage cannot be ignored. Missing 2 payments could trigger your card's penalty interest rate, which can be costly. Although federal law does not limit the interest rates that credit card companies can charge, states may set ceilings, according to the Consumer Financial Protection Bureau.